So as we were going into the data for 2016 early stage investments, we found from the perspective of let's say the entrepreneurs seeking to raise this kind of capital, both good news and bad news. Just to kick off with the bad news, like you said, Series A investments have, at least compared to 2015, come crashing down. So we used to see a median of at least 20 investments per month in 2015, which has come down to as low as 11 investments per month in 2016. This is the Series A investments. So if you are an entrepreneur who has raised some kind of seed capital from an angel investor or a seed fund and are now looking to raise upwards of $2 million, the situation doesn't look very rosy at this point. But we also looked into the fundraising data and to see if there is any clue in terms of why the slowdown in Series A investments. There we found that whether it is some of the most active Series A investors in the past few years, whether it is names like IDG Ventures, Kalari Capital, Sequoia, Nexus Ventures, they've all raised new funds. So clearly the answer for the slowdown in Series A is not in the money availability in the system. All of these funds who do Series A investments have enough dry powder with them. So now kind of looking at the good news for entrepreneurs, the specialist seed funds, like Your Nest Angel Fund, Bloom Ventures, India Quotient, they have been maintaining a brisk pace of investments that they had set in 2015, at least 13 investments a month. They are carrying on with that pace even in 2016. So that's clearly good news for the entrepreneurs who are looking at seed capital.
All right, Chandra, I'm going to bring in Sunil Goyal at this point of time. Sunil, this is Krishna coming to you from ET Now's Mumbai studios. Tell me, at a time when regular venture capital funds are slowing down in doing Series A deals, what exactly is encouraging seed funds to keep up their pace?
You see, this is the period when the valuations have become realistic. It is the time when the quality of entrepreneurs has continuously improving. See, when an exuberance period ends, the party ends, it doesn't mean that the quality of entrepreneurs and the quality of ideas die out. It is only about that availability of money is restricted to higher quality entrepreneurs. And that is what we are finding is that now the pre-Series A or seed investors like Your Nest, Bloom, India Quotient, etc. are able to find attractive valuations, and hence we are continuously looking at newer sectors, newer avenues from the emerging sectors like IoT, cloud, virtualization to SaaS platforms, etc. and some unique consumer businesses as well. So that's the reason we are continuously investing in the Series A, pre-Series A stage.
Right, encouraging words coming in there from Sunil. But Arun, give us broader perspective of the precedence here. Are we staring at what, a 5 or 6 year low? And also in terms of the number of deals, how is it different from previous years?
Sure. So if you take a month like let's say March of 2015, we saw as many as 20 Series A deals and something like 7 seed deals only. Now if you compare that to March 2016, the number of seed deals are at 10, which is higher than the comparable month, but the number of Series A investments has come down to 7. So clearly the lines are crossing vis-a-vis seed and Series A. But if you take the historic average kind of thing, especially if you take the median number across the years, 2015 was clearly an aberration. If you take that out, this number of 11 Series A investments is not too bad. So 2014 we saw was around 14 in terms of the average Series A investments per month. So historically compared to 2014 and 15, this number is low. But overall before that, this number of 11 Series A is not too bad.
Right, Sunil, based on your conversations with Series A investors, what is the reason for them slowing down? And also, is this pace of seed investments sustainable, given that your portfolio companies will come up for Series A rounds in 6 to 12 months' time from now?
See, after a period of exuberance, there is always a hangover period that is going to be there. So there is some mild slowdown. That doesn't mean that the money is not available with the Series A guys. Our purpose of investing in pre-Series A or a seed round is to ensure that we build such high quality companies that the kind of traction and the kind of stability between growth and profitability and sustainability that the Series A guy is going to be looking forward to, we're able to build those kind of companies and identify those kind of companies, and definitely they'll come back. To give an example, last year same time we had 7 companies in our portfolio, and 5 of them saw an up round in the last 12 months, and some of them after the party was over. So that kind of conviction that we have is that once you build a right company, money will flow in, maybe a little later.
Arun, is there a question that you want to ask Sunil, considering, both of us are joining us here? Is there anything that you want to ask him in terms of the pattern that you're seeing here?
Yeah, so you have set a very brisk pace for this year, as many as 5 investments. So this is clearly the highest number of investments you have done in a year, right, in terms of the pace?
Oh yes, let me just classify the last 4 years of Your.Nest. The 2012 was a stability period. 2013 to mid of 14 was a period when liquidity was tight and it was a tight period. Then was a 1 year of exuberance, and then the softening started. In this softening period is when we started making investments. During that particular 1 year of exuberance, we were only doing follow-on investments in our companies, or looking at some B2B businesses that were coming with the right teams and the right valuations to us, and they were in such a unique space that we had a time to build them and get them ready for the Series A now. So it is just because there was a pause of our investing in you can say 2014 second half to 2015 first half. So that particular deal flow is what you are seeing being reported now in the last 7-8 months, and these are the companies which are even in the consumer space, not only in the enterprise space, from artificial intelligence like RAR, from B2B e-commerce like AHA Stores, to consumer companies like SmartQ and Fashlots, which we believe can sustain for 12 to 18 months or even 24 months with our capital of $500,000, and hence by the time the good market scenarios come by, they're ready for our Series A and B rounds.
All right, Sunil, finally, before we wrap things up, tell us, some investors are asking startups to be frugal in spending and also go for multiple seed rounds before getting to Series A. Is that a good thing or a bad thing? Because it could hamper investments needed for growth.
Being frugal in the initial days of a startup helps them build a lasting organization. The character of an organization, a culture of an organization is built around that. Yes, having money through multiple rounds of seed rounds or pre-series A rounds, etc., is a tough task for them in the initial period, that they have to be continuously in the market to raise money. But people like us, we keep enough money. Any angel investor has to keep enough money for the follow-on rounds for their existing companies. We do that. We have in a first fund of 90 crores, we've kept 30 crores for follow-on rounds. So follow-on rounds prior to Series A or along with Series A is what we need to be keeping enough cushion. So it is about discovering and rediscovering your business with these these multiple rounds, and then hit the market with bigger customer base, better customer traction, and raise confident money from Series A guys.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.